Imagine waking up one morning and realizing the entire U.S. housing market is being held up by a $2 trillion bet. A bet Wall Street placed at the absolute peak, and that bet is now cracking open from the inside. Because new data quietly released in the last few weeks shows something we've never seen before. The first stage of what insiders are calling an institutional liquidation cycle. This isn't about homeowners losing equity. It's about the biggest players in American housing starting to drown. And here's the twist. The same zip codes, counties, and neighborhoods that Wall Street aggressively bought up are now the same places experiencing the steepest price drops. In the next few minutes, I'll show you where the damage is happening first, and why this could trigger the biggest buying window in a decade. To understand the collapse, we have to rewind to 2020 to 2022. Cheap money, low rates, and unprecedented institutional confidence created the fastest land grab in modern real estate history. Funds, REITs, and private equity firms were outbidding families, paying cash and sometimes offering 20 to 30% above list price to secure entire neighborhoods. At the time, they believed these homes would appreciate no matter what. But real estate doesn't reward arrogance, it punishes it. How the bubble formed. Wall Street wasn't buying randomly. They were targeting high-growth metro areas, pandemic migration, hotspots, Sunbelt cities, tax-friendly states, markets with rising rents, and because they bought so aggressively, their collective actions inflated local prices beyond sustainable levels. This is where the unraveling begins. The valuation shocked. Fast forward to today. New data shows a reversal so sharp, even seasoned analysts didn't expect it. Areas with the highest institutional ownership are seeing the fastest year-over-year price declines. Many of the properties purchased during 2021 to 2022 are now worth tens of thousands less than what these funds paid. And because institutions didn't buy with cash alone, they leveraged almost everything. Every percentage drop hits them twice as hard. This isn't a soft landing. This is leverage colliding with falling asset values. Why Wall Street is feeling the pain first? Most people assume individuals feel housing pain first. Not this time. Institutions have debt covenants, annual return targets, shareholder pressure, regulatory reporting deadlines, mark-to-market requirements when prices fall. They can't just wait it out. They have to react, and they have to react fast. That's why we're now seeing early signs of panic, selling strategic listings, sudden price cuts, and accelerated portfolio adjustments. The hidden reason this collapse is different. In 2008, individuals defaulted. This time, the risk is concentrated in centralized pockets of Wall Street ownership. Certain metros have entire subdivisions owned by institutions, rent prices controlled by a handful of funds. Housing supply dependent on investor behavior, so when institutions sell, the impact compounds quickly. The first markets showing fractures without repeating competitor content. Here's the pattern emerging now. Sunbelt states. These markets saw the highest investor enthusiasm and now show the strongest price declines. Boomtown metros. Cities that saw rapid in-migration are now seeing rapid outflows as affordability collapses. Overbuilt suburbs, highly leveraged buyers pushed up land values. Now, those same buyers are trying to unwind. Investor clusters, neighborhoods where more than 15 to 20% of homes are investor-owned, are now seeing the fastest price corrections. This pattern is consistent across multiple data sources. Why their losses are much worse than they seem. Every institutional property has maintenance taxes, insurance, interest, vacancy costs. Most of these rose dramatically over the last 24 months, especially insurance in Florida, Texas, and the Gulf Coast. So even if a property maintains its value on paper, the cash flow is deteriorating. But when valuations decline and operating costs rise simultaneously, that's when the financial structure breaks. The debt problem that no fund can ignore. Many of the purchases were financed through credit facilities, securitized rental pools, short-term interest-only loans, floating rate structures. When rates rose, the cost of carrying these assets skyrocketed. Some funds saw their interest expenses double. But here's the bigger issue. Loan agreements require the property values to stay above certain thresholds. When values fall, lenders can demand more capital, more collateral, immediate restructuring, or forced liquidation. And right now, lenders are doing exactly that. Why this is only the first stage. Institutional portfolios don't collapse all at once. They collapse in phases. Quiet internal warnings, credit tightening from banks' margin calls and collateral requests, selective selling. Portfolio optimization, announcements, block sales, and off-market unloading, public panic once earnings reveal the truth. Based on recent earnings calls, or between stages 3 and 5. Here's the twist almost nobody sees. Even if housing prices stabilize, institutional investors will still be forced to sell. Why? Because their returns have evaporated. Most funds projected 8 to 10% annual rent growth, 5 to 7% home price appreciation. Stable insurance, stable financing's teed. They got rent growth slowing, prices declining, insurance exploding, financing doubling, vacancy rates rising. Their spreadsheets don't work anymore. This isn't a market problem, it's a business model failure. Inventory in investor-heavy markets is climbing rapidly. Funds are quietly taking losses rather than holding for recovery. Many institutions have paused all purchases through 2025. Banks are reducing exposure to single-family rental debt. Several major funds are downgrading their return forecasts. Insider reports show early-stage negotiations for bulk asset sales. Renters in investor-heavy areas are seeing sudden, unexplained rent increases, desperation for yield. Institutional selling could remove price floors that families relied on. Some markets may see double or triple the normal inventory levels by 2026. Funds are analyzing which metros to abandon entirely, and some decisions are already made. Here's why all of this matters to you. For regular homebuyers, the next 12 to 18 months may become the best buying window since 2012. Why? Because institutions sell differently from individuals. Individuals want maximum price, emotional value, perfect timing. Institutions want liquidity, compliance, capital preservation, fast exit. They don't need to fall in love with a price. They need to stop losses from compounding. This means negotiation leverage shifts to buyers, discounts become common, bulk sales depress surrounding comps. Homes are regionally impossible to get become accessibly air, approaching a historic moment where the biggest players in housing are about to step aside, and that opens doors for everyday Americans who are shut out during the frenzy. But here's the bigger question. What happens if the loans tied to these collapsing portfolios start failing? Because some of these loans are packaged into financial products that reach far beyond housing. They flow into pension funds, insurance companies, global investment vehicles. In my next video, I'll break down how a wave of institutional defaults could create a second financial shock, and which markets would feel it first. If you found this deep dive valuable, make sure to subscribe, turn on notifications, and like this video so more people can see what's actually happening behind the scenes. This channel breaks down the real numbers without fear, without hype, just the truth the institutions won't volunteer. Thanks for watching, and I'll see you in the next one.